Hi everybody, welcome back to the channel. In the previous episode, we learned a bit about call selling and the game of the call sellers to favor their view. In this episode, we will learn a bit about put selling and the game of the put sellers in the market to favor their view. So let's head to the charts. Here we're going to be talking about option sellers. Alright, and what are the two types of options? Call and put. Alright, now a put seller, if you are a put seller or a put seller enters the market with a bullish view, meaning the market is going to go upwards, is going to make an upside move, making a higher high and higher lows. Okay, and the basic principle in such a market is that you sell high and you buy low. Alright, so as a put seller, you would have a bullish view. And of course, as a call seller, you too wouldn't mind a sideways view. Alright, because he is going to make a money. He's going to make money in a sideways view. Why? Because as a put seller, you have sold your put, and on the other side, there's a put buyer who has bought the put from you and he has paid the premium, and that premium the put seller has received or collected, which is already in your pocket. Alright, now till the expiration date, if the premium decays, the put seller is gonna make money. Also, as we saw in the case of a call seller, if it goes slightly against his view, if the market is slightly bearish, remember a put seller enters the market with a bullish view, but if it goes slightly bearish, alright, he still makes money till his put value is exhausted. Alright, remember that. Of course, he doesn't want, as a put seller, you wouldn't want the market to go downwards against your view. Alright, in that case, you lose money. Alright, now a put seller sells a put option, and in this scenario, the profit he makes is the premium he has collected. Okay, remember, there is a put seller. On the other side, there is a put buyer. So the put buyer is buying the put from the put seller and he is paying a premium, and that premium is being collected by the put seller, and that is the profit a put seller makes. Alright, okay, and here, as we saw in the case of call seller, he has the potential to make unlimited loss. Once again, because of this factor of potential unlimited loss, the exchanges have something called a margin, and they have to pay a huge margin, which I believe if you buy one lot of a Nifty which consists of 50 units, a put seller may be required to pay a huge margin, something like 1.3 or 1.5 lakh they should be having in their trading account. Alright, okay, but of course, he wouldn't want to, on just a few thousand rupees, he wouldn't want to put or have such a huge margin in his trading account. His aim would be to earn much bigger profits. Okay, now for that, he needs to buy a lot of lots of Nifty. For that, a lot of cash is required. So the exchanges have something called collateral. So instead of paying huge amount of cash as margin, they can utilize, the put seller can utilize his or her equities in the portfolio, the mutual funds he has, bonds or government securities he or she has. Alright, once again, as we saw in the case of a call seller, since the margin is so huge and so high, only few people can afford this huge margin, and that is the reason we have very few option sellers and a lot of option buyers. As explained earlier in the previous episode, that the option buyers, the only amount they have to pay is the premium. Alright, but in case of, and that's why you have a lot of option buyers in the market, say 80 to 90%. On the other hand, because of the huge margin, few option sellers are there. Alright, now who are these option sellers? They are no one but the FIIs, DIIs, fund houses, and the high net worth investors, traders. Only they can afford such huge collateral. Now here starts their game. Alright, now what do they do in the market? They buy and sell shares, and they also trade in options and futures market. So this is basically their activity in the stock market. Alright, now through the reports and research, as we said in the earlier episode, from across the globe, if they get an idea that the market is going to go against their intended move, remember, as a put seller, he wants the market to go upwards. That is the reason he is entering the market. That is the reason he will be taking a lot of putting a lot of margin at stake. right? So he wants the market to go upwards. But through his reports and researches, he finds out that it's gonna be some bearish news on the way. What he starts doing, he starts buying shares. Alright, he starts buying shares and seeing the momentum. The small time retailers, investors, and traders, they too start buying into shares. Now, what happens because of this? There is an uptick, or there is a upside movement in the stock market. It goes up, favoring the view of the put seller. Alright, remember, put seller will enter the market if there is bullish trend. So this way they get a bullish trend and they become put sellers. Alright, okay. What is the profit probabilities? It's exactly, the situations are exactly opposite of that of call option seller. They make profit, put option seller makes profit when the market is bullish, favoring their view. They also make profit when the market is sideways, and of course when the market is slightly bearish, they have the chance to make a bit of value, a bit of a profit when the till the put value is exhausted. And if it goes way against their intended move, it goes downside. In case of a put seller, they make a loss. So as we saw in the case of a call seller, put seller also has a probability to make profit 3 out of 4 times in the options market. Alright, I hope you like this video. See you in the next episode. Thank you for listening. Bye bye. Hit the like button, subscribe if you haven't already, and as usual, have a great day. Bye bye.